The impending crash of the Canadian housing market. A perfect storm of economic challenges. The Canadian housing market is teetering on the edge of a precipice. Caught in the crosshairs of a perfect storm of economic challenges. Recent developments, including the Bank of Canada's relentless interest rate hikes, a downgraded forecast for home sales by the Canadian Real Estate Association, CREA, and the Office of the Superintendent of Financial Institutions, OSFI, proposed changes to deter extended mortgage terms, have set the stage for an imminent crash in the Canadian housing market. This video and information delves into the details and explores how these events are converging to create a future flood of for-sale listings that will inundate the market. Near the end of the video, 3 recent articles are summarized which highlight the issues we'll discuss. Impact of Bank of Canada's rate hikes. The Bank of Canada's unprecedented series of interest rate hikes has unleashed a wave of financial tremors throughout the housing market. With each increase, the cost of borrowing becomes increasingly expensive, placing additional strain on homeowners and potential buyers alike. These hikes were intended to curb economic growth and rein in stubbornly high core inflation. Although inflation has shown a marginal decline, it remains significantly elevated, hovering around 3%. And continues to pose a threat to the stability of the Canadian economy. The rate hikes have also dampened consumer sentiment and reduced overall purchasing power, exacerbating the challenges faced by the housing market. Downgraded forecast for home sales. The Canadian Real Estate Association, CREA, has revised its outlook for home sales in a sobering acknowledgement of the market's fragility. The resumption of rate hikes by the Bank of Canada has injected a renewed sense of uncertainty, causing the recent surge in sales activity to lose momentum. Buyers, once eager to jump into the market, are now adopting a more cautious approach. This shift in sentiment is compounded by a dwindling supply of new listings, which has restricted the market's ability to sustain the current pace of transactions. As a result, CREA has downgraded its forecast for home sales, signaling a weakened demand and a potential shift in the market's dynamics. These predictions themselves will have a dampening effect on the housing market, as potential buyers may anticipate that lower sales numbers will lead to lower prices and then choose to wait for more favorable conditions to buy a home. OSFI's proposed changes to mortgage terms. Recognizing the risks associated with extended mortgage terms, the Office of the Superintendent of Financial Institutions, OSFI, has taken a proactive stance. Their proposed changes aim to deter the proliferation of forever mortgages and the negative amortization that accompanies them. In a rising rate environment, borrowers with variable rate mortgages are witnessing their amortization periods stretching to unprecedented lengths of 60, 70, or even 90 years. This phenomenon can lead to negative amortization, where borrowers' payments fail to cover the growing interest, resulting in a perpetually increasing loan balance. By requiring banks to hold more capital against mortgages with growing balances, the OSFI seeks to instill resilience into the mortgage finance system and mitigate the risk of default and foreclosure. The combination of the Bank of Canada's rate hikes, the downgraded forecast for home sales by CREA, and the OSFI's proposed changes to deter extended mortgage terms all point towards an impending crash in the Canadian housing market. The increasing cost of borrowing, sluggish economic growth, weakened demand, and the risks associated with negative amortization create an environment ripe for a deluge of for-sale listings. This impending flood of listings will put further downward pressure on home prices and challenge the stability of the housing market. Stakeholders, from homeowners to lenders to policymakers, must prepare for the storm ahead and implement proactive measures to mitigate the potential fallout and safeguard the long-term health of the Canadian housing market. What do you think? Please join in on the conversation by leaving a comment. The following 3 news articles highlight our previous discussion. Bank of Canada raises key interest rate for the 10th time since March 2022 from CTV News on July 12, 2023. The Bank of Canada has raised its policy interest rate by 25 basis points, bringing the overnight rate to 5%, the highest level since 2001. The rate increase aims to slow economic growth and reduce core inflation, which has been persistently higher than expected. Inflation has decreased from its peak in 2022 but remains elevated, and the bank predicts it will remain around 3% over the next year. The bank expects Canada's real GDP growth to slow and forecasts a pickup in economic growth in 2025. CREA updates resale housing market forecast, from Canadian Real Estate Association, CREA, on July 14, 2023. The Canadian Real Estate Association has downgraded its forecast for home sales in 2023 and 2024 compared to its previous outlook. The resumption of rate hikes by the Bank of Canada has introduced uncertainty into the housing market, causing the recent sales rally to lose steam. New listings are catching up to sales, but this is not expected to lead to significant gains in activity, as some buyers may move to the sidelines in response to higher interest rates. CREA predicts a decline in home sales in 2023 and expects prices to stabilize or rise at a slower pace. Bank regulator steps in to deter banks from extending mortgages to as long as 90 years, from the Star on July 13, 2023. The Office of the Superintendent of Financial Institutions, OSFI, has proposed changes to reduce the risk posed by forever mortgages, where variable-rate mortgage borrowers see their amortization periods extend to 60, 70, or even 90 years. The proposed changes would require banks to hold more capital to address the risks related to mortgages with growing balances. The Bank of Canada's rate hikes have increased the risk of negative amortization, where borrowers' payments are not enough to cover the growing interest, resulting in a balance that continues to grow. The changes are aimed at ensuring banks maintain adequate capital buffers to absorb this risk. Please join in on the conversation by leaving a comment. If you found this video and information useful, please smash the subscribe button and hit the notification bell so we can keep providing you with timely information you can apply on a daily basis.